Institutional Equity Research Report. Nasdaq, HAPN, formerly NYSE, LC. HAPN Inc., LendingClub. LendingClub renames itself HAPN Bank and moves to Nasdaq, the business behind the new name. Section 1. Executive Summary. Important note on naming. LendingClub Corporation officially changed its name to HAPN Inc. on June 22, 2026, rebranding its banking subsidiary as HAPN Bank and moving its stock listing from the New York Stock Exchange, ticker LC, to the Nasdaq Global Select Market under the new ticker HAPN. This report covers the same company the person requesting it knows as LendingClub. The business, management team, and financial history are continuous. Only the name, ticker, and exchange have changed. HAPN, formerly LendingClub, is a San Francisco-based digital bank that began in 2006 as one of the original peer-to-peer lending platforms before acquiring Radius Bank in 2021 to become a chartered deposit-taking bank holding company. Today, the business operates as a hybrid marketplace bank. It originates personal loans and, more recently, home improvement loans through a new partnership with Wisetack, funds a portion of those loans with its own deposit base, and sells the remainder to a network of institutional investors, earning both net interest income on loans it keeps and origination and servicing fees on loans it sells. The rebrand comes in a moment of genuinely strong operating performance. Q2 2026 results, reported July 27, 2026, showed record pre-tax income of $76 million, a 28.8% pre-tax margin. Loan originations up 29% year-over-year to $3.1 billion, exceeding the high end of management's own guidance, and diluted EPS of 50 cents, comfortably beating the 42 cents analyst consensus. Management raised its full-year 2026 EPS guidance to $1.80 to $1.90, up from a prior $1.65 to $1.80 range and above the $1.74 Wall Street consensus at the time. Key facts at a glance. New name/ticker. HAPN Inc. /Nasdaq HAPN, effective June 22, 2026, formerly LendingClub Corporation, NYSE, LC. Business: digital marketplace bank, personal loans, home improvement financing, high-yield savings, and checking accounts. CEO: Scott Sanborn since 2016. Members: 5 million plus. Q2 2026 revenue, $262.9 million. Q2 2026 diluted EPS, 50 cents versus 42 cents consensus. Q2 2026 loan originations, $3.1 billion, plus 29% year-over-year. FY 2026 EPS guidance, $1.80 to $1.90, up from a prior $1.65 to $1.80 range. This report is intended to give both professional and retail investors a clear-eyed, plain English view of the company's business, its most recent quarterly results, and the key risks and catalysts likely to matter over the next 12 to 24 months. It is not a recommendation to buy, sell, or hold HAPN shares. Section 2. Investment Thesis. The bull case for HAPN centers on a genuinely rare combination in consumer fintech: sustained superior credit performance. Management cites more than 40% credit outperformance relative to competitors across 5 years of quarterly loan vintages, alongside accelerating growth and record profitability, all trading at a valuation multiple, roughly 12 to 13x forward earnings, that independent analysis has specifically flagged as a material discount to fintech-oriented peers like SoFi Technologies, despite HAPN's now diversified, deposit-funded bank model, reducing much of the balance sheet risk that plagued the original peer-to-peer LendingClub model. The rebrand itself is a deliberate strategic signal. Management wants Nasdaq-listed tech-oriented investors comparing HAPN to SoFi, not to legacy bank holding companies. The bear case is that HAPN operates in a genuinely rate-sensitive, credit-cycle-exposed business. The company itself acknowledged that expected Fed rate cuts did not materialize as anticipated entering 2026, pressuring loan sale pricing. And management has been explicit that net charge-offs, loans that go bad and aren't repaid, are expected to normalize higher from a currently favorable 3.5% back toward roughly 5% as newer loan vintages season. The recent shift to fair value accounting for loans also introduces more quarter-to-quarter volatility into reported non-interest income, which fell 11% year-over-year in Q2 2026, despite the overall strong quarter, a nuance investors need to understand rather than read as a negative signal in isolation. Thesis in one sentence. HAPN, formerly LendingClub, offers investors a newly rebranded deposit-funded digital bank with genuinely superior credit performance and record profitability, trading at a discount to fintech peers, but the business remains inherently exposed to interest rate movements and eventual credit normalization that could pressure the very metrics driving today's strong results. Section 3. Company Overview. Legal Entity. HAPN Inc., formerly LendingClub Corporation. Banking Subsidiary, HAPN Bank National Association, formerly LendingClub Bank. Headquarters, San Francisco, California. Exchange/ticker, Nasdaq Global Select Market /HAPN since June 22, 2026. Previously, NYSE/LC. Founded 2006 as a peer-to-peer lending platform. Chief Executive Officer, Scott Sanborn, CEO since 2016, joined as CMO in 2010. Chief Financial Officer, Andrew Drew Leben. Target customer, the motivated middle, high-income, high-credit score consumers who remain active users of credit. Corporate milestones. Date, milestone, 2006, company founded as one of the original online peer-to-peer lending marketplaces. 2014, LendingClub completes its IPO on the NYSE under ticker LC. 2016, Scott Sanborn named CEO following a governance and compliance crisis under the company's prior leadership. 2021, acquires Radius Bank, converting LendingClub into a chartered deposit-taking bank holding company, a pivotal structural shift, enabling the company to fund loans with its own deposits rather than relying solely on marketplace investors. April 2026, launches home improvement financing, loans up to $65,000 via a new partnership with point-of-sale lender WiseTac, embedded across more than 40,000 contractors. April 2026, publicly announces plans to rebrand as HAPN Bank. June 22, 2026, officially completes rebrand to HAPN Inc./HAPN Bank and begins trading on Nasdaq under ticker HAPN, having traded as LC on NYSE through June 18, 2026. June 30, 2026, rings the Nasdaq opening bell to mark the listing transition. July 27, 2026, reports record Q2 2026 pre-tax income of $76 million, raises full-year 2026 EPS guidance. Section 4. Business Model. HAPN operates what management calls a capital-light marketplace model, layered on top of a traditional bank balance sheet. When a member is approved for a loan, HAPN has flexibility in how it funds that loan. It can hold the loan on its own balance sheet, funded by customer deposits, earning net interest income over the life of the loan, or sell the loan to one of its network of institutional investors, earning an upfront origination fee plus ongoing servicing fees without carrying the loan's credit risk long-term. This dual funding approach lets HAPN scale loan originations without being entirely constrained by the size of its own deposit base, while still benefiting from the funding cost advantages a bank charter provides relative to a pure non-bank marketplace lender would have. In 2026, the company adopted fair value accounting for a larger share of its loan portfolio, meaning that instead of recognizing potential future loan losses gradually over time through a loan loss provision, the traditional approach, HAPN now recognizes origination fee revenue immediately and reflects expected credit performance through fair value markdowns at the time of origination. This is an important mechanical change for investors to understand. It makes certain revenue and expense line items, like origination fees in fair value markdowns, larger and more front-loaded than under the old accounting method, without necessarily changing the underlying economics of the loans themselves. How to think about it. Think of HAPN as running two businesses at once, a traditional bank that takes deposits and earns interest on loans it keeps, and an asset-light marketplace that originates loans, sells most of them to outside investors, and collects fees for doing so, giving it more funding flexibility than either a pure bank or a pure marketplace lender would have alone. Section 5. Products and Services. Product Description. Personal loans. The company's original core product, unsecured installment loans, typically used for debt consolidation and major purchases, targeted at the motivated middle, high credit quality customer segment. Home improvement financing. New product launched April 2026 via partnership with WiseTech. Loans up to $65,000 embedded at the point of sale across more than 40,000 partner contractors nationwide. High-yield savings accounts, deposit product allowing HAPN Bank to fund a portion of its loan originations directly, reducing reliance on marketplace loan sales. Checking accounts, core banking product supporting the company's broader positioning as a full-service digital bank rather than a single-product lender. Underpinning all of these products is HAPN's proprietary underwriting model, which the company states is informed by more than 150 billion data cells accumulated from nearly 2 decades of lending activity. A data advantage management credits as central to the credit outperformance discussed throughout this report. As of Q2 2026, HAPN serves more than 5 million members across this expanding product suite. How to think about it. The WiseTech-powered home improvement financing launch is a genuinely important expansion beyond HAPN's historical single-product identity as a personal loan company. It's the first concrete evidence of the diversified digital-first bank positioning behind the rebrand, actually showing up in the product lineup, not just the marketing. Section 06. Industry Overview. The U.S. digital consumer banking and lending industry has continued consolidating around a smaller number of well-capitalized multi-product platforms, as pure-play single-product fintech lenders have increasingly found it difficult to compete on customer acquisition costs and funding stability against banks and diversified fintechs with their own deposit bases. HAPN's own strategic evolution from single-product peer-to-peer lender to bank-chartered lender via the Radius acquisition to now a multi-product digital-first bank under the HAPN brand directly mirrors this broader industry consolidation toward diversified, deposit-funded models. CEO Scott Sanborn has explicitly framed the rebrand as a competitive repositioning against SoFi Technologies, Ally Financial, and Capital One, arguing that large-scale, up-funneled brand marketing, the kind of spending that supports stadium naming rights and mass-market advertising, which SoFi has notably pursued, only makes economic sense once a company offers a broad enough product suite to justify reaching a mass-market audience, something the narrower LendingClub identity, built around a single personal loan product, did not support as effectively. Section 7. Market Opportunity. HAPN's most immediate growth opportunity is continued expansion of loan originations, which grew 29% year-over-year to $3.1 billion in Q2 2026, exceeding the high end of management's own $3 to $3.1 billion guidance range, specifically targeting the same mainstream mass market positioning that has helped SoFi Technologies build broader brand recognition through large-scale marketing investments that a single product lender could not economically justify. How to think about the opportunity. This isn't really a story about a new addressable market opening up. It's a story about a company betting that a broader brand and product suite can capture more value from its existing 5 million-plus member base and attract new customers more efficiently than its old, narrower positioning allowed. Section 8. Competitive Landscape. Competitor Listing. Positioning. SoFi Technologies. Nasdaq, SOFI. The most directly cited competitor following HAPN's rebrand, broader mass-market consumer fintech brand with substantial marketing scale, including NFL stadium naming rights, spanning lending, banking, and investing products. Ally Financial, NYSE, Ally. Established digital-first bank with a broader auto lending and deposit franchise. Capital One, NYSE, COF. Large, diversified bank and credit card issuer with substantial scale advantages, particularly relevant following its 2025 acquisition of Discover Financial. Upstart Holdings, Nasdaq, UPST. AI underwriting-focused personal loan marketplace, a more direct product-level competitor in personal lending specifically. Prosper Marketplace, private. One of HAPN's original peer-to-peer lending category peers, remaining privately held. Where HAPN stands. HAPN's stated key differentiator is credit performance. Management has cited more than 40% credit outperformance relative to competitors across 5 years of quarterly loan vintages, alongside net charge-offs that have consistently beaten the company's own forecasts, falling to 3.5% in Q1 2026 from 6.1% a year earlier, before an expected, seasonally normal move back toward roughly 5%. Independent analysis has specifically noted that HAPN trades at a meaningful valuation discount, roughly 12 to 13 times forward earnings, relative to SoFi and other fintech-oriented peers, despite this credit discipline and its now diversified deposit-funded bank model, a gap the rebrand and associated Nasdaq listing are explicitly intended to help close over time by inviting more direct comparison to those peers. Section 9. Management Team. Scott Sanborn, Chief Executive Officer since 2016. Joined the company as Chief Marketing Officer in 2010 and was named CEO in 2016 following a governance and compliance crisis under prior leadership, successfully leading the company's stabilization, its 2021 acquisition of Radius Bank, and now its 2026 rebrand to HAPN Bank, a change Sanborn has said he personally advocated for since his original 2010 job interview. Sanborn has framed the rebrand as reflecting the company's evolution beyond lending into a diversified digital-first bank, combining deposits, lending, and a capital-light marketplace model, and has been explicit that the strategy targets a specific customer segment he calls the motivated middle, high-income, high-credit score consumers who remain active, engaged users of credit products. Andrew Drew Leben, Chief Financial Officer, oversees the company's financial strategy through its transition to fair value loan accounting and its rebrand-driven exchange listing transfer. On the Q2 2026 earnings call, Leben confirmed that second quarter originations exceeded the high end of guidance and detailed the mechanics of the shift to fair value accounting, including the treatment of origination fees and fair value markdowns discussed in Section 4. Section 10. Financial Performance. Metric. Q1 2026, Q2 2026. Revenue. $252.25 million, $262.86 million. Diluted EPS, 44 cents, 50 cents. Pre-tax income, $67.3 million, then record. $76 million, new record. Loan originations, $2.7 billion, plus 31% year-over-year. $3.1 billion, plus 29% year-over-year. Net income, $51.6 million. Information not publicly available as a standalone figure in this source set. In plain terms, HAPN delivered 2 consecutive quarters of record pre-tax profitability in the first half of 2026, with both revenue and originations growing at a healthy double-digit pace, even as the interest rate environment turned out less favorable than management originally expected. Anticipated Fed rate cuts did not materialize as planned. Net margin stood at approximately 17% and return on equity at roughly 11.9% as of the most recent quarter, solid profitability metrics for a company of this scale. Balance sheet strength as of Q1 2026. These capital ratios sit comfortably above typical regulatory well-capitalized thresholds, reflecting the balance sheet strength the company has built since becoming a chartered bank via the Radius acquisition, a meaningfully different and generally lower-risk funding profile than the company had as a pure marketplace lender before 2021. Section 11. Detailed analysis. Latest quarterly earnings Q2 2026. Revenue. Total revenue was $262.86 million, roughly in line with a $262.35 million analyst consensus, and reflecting continued growth in both origination fee income and net interest income from the company's loan and deposit balance sheet. Gross margin, pre-tax margin. Pre-tax profit margin was 28.8%, with pre-tax income reaching a record $76 million, up from the prior record of $67.3 million set just 1 quarter earlier in Q1 2026, demonstrating sequential momentum in underlying profitability. Operating income. Origination fees rose 87% year-over-year to $164 million, reflecting both higher loan volume and the accounting change discussed in Section 04 that recognizes these fees immediately upon origination rather than ratably over time. This was partially offset by total fair value markdowns of $121 million, up from $89 million in Q1 2026, reflecting higher originations, growth in loans carried at fair value, and higher benchmark interest rates during the period. Net income. Diluted EPS was 50 cents, beating the 42-cent consensus estimate by 8 cents, continuing a pattern management highlighted of beating both EPS and revenue estimates in 100% of quarters over the trailing year. Return on tangible common equity rose to nearly 16% for the quarter. EPS. 50 cents diluted EPS versus 44 cents in the prior quarter, Q1 2026, and up from a lower year-ago comparison base, reflecting continued sequential earnings growth. Cash flow and balance sheet. Detailed standalone Q2 2026 cash flow statement figures and updated balance sheet metrics, total assets, deposits, capital ratios as of June 30, 2026. Information not publicly available in the specific sources reviewed for this report beyond the Q1 2026 figures cited in Section 10. Readers should consult the complete Form 10-Q on SEC EDGAR for full Q2 2026 balance sheet detail. Guidance. Management raised full-year 2026 EPS guidance to $1.80 to $1.90, up from a prior $1.65 to $1.80 range and above the $1.74 analyst consensus at the time of the update. The company also provided Q3 2026 EPS guidance of 43 cents to 48 cents. Management commentary. CEO Scott Sanborn stated that loan originations increased 29% year-over-year to $3.1 billion, with pre-tax income reaching a record $76 million, adding, "We're growing and growing profitably despite the adverse rate environment," citing loan demand, credit performance, marketplace activity, and growth in banking products.
CFO Drew LeBen confirmed that second quarter originations exceeded the high end of the company's guidance range and detailed the mechanics behind the year-over-year decline in non-interest income, attributing it to the shift to fair value accounting rather than any underlying business weakness. Key changes versus previous quarter. This was the company's first earnings report under its new HAPN Inc. name and Nasdaq listing, following the June 22, 2026 rebrand. Pre-tax income set a new company record, $76 million, up from the prior record, $67.3 million, set just one quarter earlier, in Q1 2026. Non-interest income fell 11% year-over-year, though it rose 10% sequentially, a decline management specifically attributed to the 2026 shift to fair value accounting rather than deteriorating underlying performance.
Full-year, fully diluted EPS guidance was raised for the second consecutive quarter, reflecting sustained upward momentum in management's own outlook. Section 12. Growth Drivers. 1. Wisetack Home Improvement Financing Expansion. Continued scaling of the point-of-sale home improvement lending partnership across its 40,000-plus contractor network represents a genuinely new growth vector beyond the company's historical personal loan-only product base. 2. Continued originations growth ahead of guidance. Originations have now exceeded the high end of management's own guidance in recent quarters. Q2 2026, $3.1 billion versus $3.0 to $3.1 billion guided, suggesting genuine demand strength that could support continued upward guidance revisions if sustained. 3. Rebrand-driven marketing efficiency. Management's stated ability to now pursue broader, up-funnel mass-market advertising rather than narrow personal loan-specific marketing could improve customer acquisition efficiency and brand recognition over time as the HAPN brand matures. 4. Superior consistent credit performance. More than 40% credit outperformance versus competitors across 5 years of vintages provides a durable competitive advantage, supporting both loan sale pricing to institutional investors and the company's own balance sheet loan retention economics. 5. Deposit growth reducing funding costs. Continued growth in FDIC-insured deposits, 88% insured as of Q1 2026, provides a stable, relatively low-cost funding source that reduces reliance on more volatile marketplace loan sale economics. Section 13. Key Risks. A. Interest rate sensitivity. The company's own guidance embedded an expectation of Fed rate cuts that did not materialize entering 2026, directly pressuring loan sale pricing to institutional investors. Continued rate uncertainty remains a genuine ongoing risk to both origination economics and net interest margin. A. Expected credit normalization. Management explicitly guided that net charge-offs, currently favorable at 3.5%, are likely to normalize higher toward roughly 5% as newer loan vintages season, a headwind to future profitability that is already anticipated but not yet fully realized in reported results. A. Fair value accounting volatility. The 2026 shift to fair value accounting for a larger share of the loan portfolio introduces more quarter-to-quarter volatility into reported non-interest income and fair value markdown figures, potentially making period-over-period comparisons more difficult for investors to interpret without careful attention to methodology. A. Rebrand execution and customer confusion risk. Changing a 20-year-old widely recognized brand name carries inherent execution risk, customer confusion during the transition, marketing spend required to rebuild brand recognition from a new name, and the risk that HAPN Bank fails to resonate as effectively as management hopes with the broader, more mainstream audience it's targeting. A. Intensifying competition from larger, better capitalized players. SoFi Technologies, Ally Financial, and a post-Discover acquisition Capital One all have greater scale, marketing budgets, or product breadth than HAPN, and the company's explicit strategic pivot to compete more directly with these players invites more direct and potentially unfavorable comparison. A. Concentration in a narrow customer segment.
The company's explicit focus on the motivated middle, high-income, high-credit score consumers means HAPN's growth is inherently capped by the size of this specific demographic segment relative to competitors pursuing a broader mass-market customer base. A. New product execution risk. The WiseTech Home Improvement Financing Partnership is a genuinely new product line for the company, launched only in April 2026. Its long-term credit performance, contractor partner retention, and overall commercial success remain largely unproven at this early stage.
Section 14. Valuation. Metric. Value. Current share price, late July 2026. Approximately $18.75 to $19.21. Market capitalization, approximately $2.17 to $2.22 billion. PE ratio, approximately 12.6 to 12.9x. 52-week trading range, approximately $10.74 to $21.67. FY 2026 EPS guidance, approximately $1.80 to $1.90. Analyst price targets, recent. Jefferies, $24, raised. Citizens, $23, market outperform. At roughly 12 to 13 times forward earnings, HAPN trades at a meaningful discount to fintech-oriented peer SoFi Technologies, despite comparable or superior credit performance metrics and a similarly diversified deposit-funded bank model. Independent analysis has specifically framed this valuation gap between a single-digit to low-teens earnings multiple and what management's stated combination of record profitability, credit discipline, and multiple growth catalysts might otherwise command as the core investment thesis for the stock. Recent sell-side price target increases, Jefferies, $24, Citizens, $23 with an outperform rating, both imply meaningful upside from the current $18.75 to $19.21 trading range, reflecting generally positive analyst sentiment following the strong Q2 2026 print. Though investors should note these targets reflect individual analysts' views rather than a verified broad consensus. Section 15. Upcoming catalysts. Catalyst, expected timing, why it matters. Q3 2026 earnings report. Information not publicly available, typically late October. Will test whether management's raised full-year guidance and Q3 EPS guidance of 43 cents to 48 cents hold up against continued rate and credit normalization headwinds. Continued WiseTech home improvement financing scaling. Ongoing. Early evidence of whether this new product line can become a meaningful incremental growth driver. Credit normalization trend, charge-offs toward 5%. Ongoing through 2026-2027. A key metric to watch for confirmation of management's own guided credit normalization path. Brand recognition, marketing efficiency progress under HAPN. Ongoing. Will indicate whether the rebrand is successfully translating into the broader, more mainstream customer acquisition management is targeted. Federal Reserve interest rate policy developments. Ongoing. Directly affects loan sale pricing, net interest margin, and overall origination economics. Section 16. Long-term outlook. HAPN's long-term outlook depends on whether the rebrand and product diversification strategy can successfully translate the company's already demonstrated credit discipline and profitability into the kind of broader brand recognition and mass-market customer growth that has helped competitors like SoFi Technologies command higher valuation multiples. The early evidence, record pre-tax profitability in back-to-back quarters, originations consistently exceeding guidance, and a new product line, WiseTech Home Improvement Financing, already contributing to growth, is encouraging. But the rebrand itself is barely more than a month old as of this report's date, making it far too early to fully validate the strategic thesis. Over a multi-year horizon, the company's success will likely hinge on three factors.
whether credit performance normalizes gradually, as management expects, rather than sharply, which would pressure profitability more severely, whether the HAPN brand successfully builds the kind of mainstream recognition needed to justify management's stated marketing strategy shift, and whether continued deposit growth further reduces funding costs and marketplace sale dependency over time. If these elements come together, the valuation discount to peers like SoFi that independent analysts have highlighted could narrow meaningfully.
Section 17. Bull Case. Bull Case Summary. Loan originations continue exceeding guidance as they have in recent quarters, with the WiseTech Home Improvement Financing Partnership scaling into a genuinely meaningful second growth driver. Credit performance normalizes only gradually, keeping charge-offs closer to management's favorable end of expectations. The HAPN rebrand successfully builds mainstream brand recognition, improving customer acquisition efficiency and supporting continued origination growth. Deposit growth continues reducing funding costs, and the market gradually re-rates HAPN's valuation multiple toward fintech peers like SoFi Technologies as the company demonstrates sustained record profitability. In this scenario, shares could see substantial appreciation from current levels toward or beyond the $23 to $24 price targets recently cited by Jefferies and Citizens analysts.
Section 18. Bear Case. Bear Case Summary. Net charge-offs normalize faster or higher than management's guided path towards 5%, pressuring profitability more severely than currently anticipated. Continued interest rate uncertainty further pressures loan sale pricing and net interest margin. The WiseTech Home Improvement Financing Partnership fails to scale meaningfully, or experiences early credit quality issues given its limited track record. The HAPN rebrand struggles to build mainstream recognition, and marketing spend increases without a corresponding lift in customer acquisition efficiency. And larger, better capitalized competitors, SoFi, Capital One post-Discover, continue outspending HAPN on marketing and product development. In this scenario, HAPN shares could remain range-bound or decline from current levels, with the valuation discount to peers persisting rather than narrowing.
Section 19. Final Investment Conclusion. HAPN, the company most investors still know as LendingClub, enters its new chapter from a position of genuine operating strength. 2 consecutive quarters of record pre-tax profitability, loan originations consistently exceeding management's own guidance, superior and well-documented credit performance relative to competitors, and a full-year earnings outlook that management has raised twice in 2026. The June 2026 rebrand and Nasdaq listing transfer represent a deliberate, CEO-championed, decade-in-the-making strategic repositioning designed explicitly to invite comparison to higher multiple fintech peers like SoFi Technologies rather than legacy bank holding companies. At the same time, investors need to weigh this strong recent performance against the inherent, ongoing risks of a rate-sensitive, credit cycle-exposed lending business. Management itself is guided toward normalizing higher credit losses ahead. The 2026 accounting change to fair value treatment introduces new complexity into quarter-over-quarter comparisons, and the rebrand itself remains too recent to fully judge its success in building the broader brand recognition management is targeting. The current valuation, at roughly 12 to 13x forward earnings, does appear to reflect the discount to fintech peers that independent analysts have specifically highlighted as the core investment case. Bottom line, HAPN, formerly LendingClub, offers investors exposure to a demonstrably improving, well-capitalized digital bank with superior credit discipline trading at a discount to fintech peers. But success will depend on sustaining credit performance through an anticipated normalization period and proving the rebrand can meaningfully expand the company's addressable customer base. This report does not constitute a recommendation to buy, sell, or hold HAPN shares. Readers should review the company's complete SEC filings and consult a qualified financial advisor before making any investment decision.